Good morning, everyone. My name is Namir Hallak, and welcome to another episode of Andersen's BizTax series, our webinar on cross-border tax with a focus on business entities. Today's topic is cross-border employees, and I am joined by my colleague, Stephen Flynn, also from our Vancouver office. Now,
Hey,
Steve, I know last week you were in Palm Springs. You did some epic sunny hikes from what I hear. What's on your itinerary for December in rainy Vancouver?
well, it's an adjustment, no question. I think a lot of our viewers may be surprised to see me on this. They may have been expecting Krista Rabideau, who is our partner, who is going to join Namir. Krista is under the weather this week, and so I have been asked to fill in. So to answer your question, Namir, December is a busy time for us here at Andersen. We've got a lot of planning activities and for our clients. We also still have some tax returns to prepare to file by mid-December, so that'll always keep us busy.
Great. Well, hey, you know what? Ski season is also officially starting in BC, so hopefully all this rain translates to snow on the slopes. Hey, you know what? Besides being excited for the snow, I know a lot of us tax geeks are also fascinated or maybe alarmed, but today is the day that the Supreme Court is hearing arguments in what is, well, otherwise an obscure tax case, but one that can have trillions of dollars in tax consequences. And the oral arguments of the U.S. Supreme Court for the Moore versus U.S. case starts today and could be, the most significant tax case in a century, or not. I guess we'll find out this summer.
Well, it is an interesting one, and it's got a local flavor to it. If I remember correctly, it's a Washington State couple that had an interest in a company that was located in India. And like a lot of our clients who are U.S. citizens who had Canadian corporations, when the Tax Cuts and Jobs Act came in 2017, there was this, and I got to remember my phrases, this repatriation tax or this tax on retained earnings, that
That's right.
unrealized income. And as you had said to me, this has a significant, potentially significant implication.
Yeah, I mean, essentially, they're challenging the constitutionality of what is realized income. Is that just because it's unrealized gain, can it actually be treated as income or not? And yeah, so exciting day for us tax geeks in cross-border tax. We'll start a little bit of housekeeping here. Quick reminder for all our attendees, our webinars are now registered with the National Association of State Boards of Accountancy, NASBA, which allows you to earn CPE credits and CPD credits simply by watching this. We do ask if you want to be eligible for these credits that you do attend the webinar for at least 50 minutes, and you also participate in the 3 polling questions. And following the webinar, our team will then send you certificates for all the qualifying attendees within a couple of hours. We do appreciate your engagement, and hopefully you find our webinars beneficial to your professional development. Now, we also know our audience always has questions, so we will allow some time at the end of the webinar for you to ask the panelists those questions. There is also a chat box there in the corner, so please type your questions in the corner, and we'll make sure to answer as many as we can in the time that we have. There's also a live transcript, so if you click on the CC button, you should be able to see the transcript of what we are saying today live. We will also provide you with a survey at the end of today's webinar. And honestly, a lot of the topics that you see coming up on BizTax and the Tax 101, we determine a lot of those topics based on the feedback from our viewers. So please let us know if there is any topic that is top of mind for you. I'm going to start with the agenda. So, hey, we've gone through some really, many different stages in the BizTax webinar series of what it looks like for a Canadian company to expand into the US. We launched our BizTax with a discussion on those very first steps of what it means to cross the border and do business in the US. And we went through those stages from the very beginning of, okay, well, what does it look like for the Canadian company to go into the US? And then we went through that life cycle of a Canadian company going into, okay, well, what is it going to look like to structure your cross-border business? What are the transfer pricing considerations you need to have between your related entities? If you have, for example, a Canadian entity and a US subsidiary, what are the strategies on how to repatriate your profits out of your US business? So we are naturally at what often comes next in the questions we get from clients in their cross-border business. And that is, at some point, the Canadian entity realizes it needs its employees to get more involved with the US activities. And you know, that can be a whole host of different activities for those employees. It could be soliciting sales, maybe they're doing some on-site activities, services, or repair work. And look, we're not going to explore any immigration questions of, you know, can your employees actually legally enter and work in the US? We're going to assume they can. But we're going to explore the tax considerations when the Canadian business wants to have cross-border employees. We're going to focus on what are those tax consequences when your employee is working in the US. So the 6 topics we're going to be looking at is managing risk with your cross-border employees, what actually is employment income, what is US business travel, the tax equalization process, and then we're going to explore the personal and business tax considerations, and we're going to wrap it up with some tax planning strategies for Canadian employers when they have cross-border employees. Now, you know, one of the reasons this really is a great topic to have with your tax advisor as you're building your cross-border business is the reality is there is risk involved with having your employees cross that border. And it's really important that we help Canadian companies manage those tax issues and risks from having cross-border employees. You know, often what I find, especially with the mid-sized Canadian companies, is they may have already taken tax positions, you know, but the reality is when you bring the total picture together, there might actually be incompatible positions. So you really want to be able to have someone step back and look at the overall picture and say, are all these tax positions aligned and compatible for your overall strategy to grow in the US? So that's looking at, you know, your corporate tax filing obligations, the payroll withholding and reporting, and also looking at your employees' tax filing obligations. You want to make sure that all these obligations are jiving, they're all aligned, they're all actually coming together for your overall tax strategy. And the issue with that is, you know, what are the risks of a misaligned tax strategy? What are the risks if any one of these things are offside or they're not actually all looking together in the same big picture aligned? Well, for the Canadian employer, that can mean that they may have liabilities for US payroll, which includes withholding and interests and penalties. They can unintentionally create a US permanent establishment. So they could be subject to US federal tax liability when their filings or their tax positions otherwise was not one that they thought they were going to be subject to US federal taxes or that they have a US permanent establishment. There could also be potential for denial of corporate tax deductions in Canada for some of those compensation costs to employees. Now, we had a webinar a little bit over a month ago on the very important topic of transfer pricing. And transfer pricing is also important here from the context of your cross-border employees. You know, the risk you have here is you can get transfer pricing adjustments, which also includes penalties, from any failures to establish that appropriate arm's length pricing between companies. Or maybe you didn't have that contemporaneous documentation that you need to maintain to support the compensation payments between the entities. So, you know, the thing to think about here from an employer's perspective is you do want to make sure these obligations are all aligned. And by the way, the risk extends beyond just tax. You know, it could also impact your financial statements, your tax provisions, because you could potentially have inaccurate financial statements if you haven't correctly accounted for that potential tax liability. Now, from an employee's perspective, what are some of the risks for an employee if we have these misalignment in the tax strategy? Well, similarly, you can also have US federal and state tax return filing requirements, you know, the liability, the interest, and penalties. You can also have a risk of double tax for those employees. So if the foreign tax credit is not claimed timely or if it's not filed correctly, you have a risk of being double taxed as an employee. Now,
Well,
another
and
thing
Namir, well, sorry, I think you see as an employee, you know, that situation can arise at probably one of the worst times, which is, you know, you've worked for a company, they asked you to spend significant time in the United States, you worked in the United States, you've now left the company, and you've gone on to another job, but you're within a few years and something happens, and I'm going to say something happens. It's an audit, it's a review, it's a company decision, or something happens. And now either the federal government, the US, or a state government is coming back to you as an employee saying, well, we understand you worked here and now you're taxable here and we'd like to see your tax returns, or, we may assess something. And now you got to go back and figure out what happened, but you're no longer working for that company. And so, from an employee's perspective, you need to be aware that when you're physically working in the United States for whether it's a Canadian company or a US company, it doesn't really matter. You may be subject to tax either federally or by state or both. And you need to be aware of those, of your responsibilities as an employee.
That's right. And you bring a good point there too, Steve, because I think another blind spot that can happen in that misalignment between what the tax strategy is and what the employees are running around doing crossing the border is you could also have some cash flow issues as an employee where, maybe they find themselves in a situation where they should have withheld income at the source and maybe they didn't. And when they go then to file a tax return as an employee at a subsequent time, they may look and realize they have some cash flow issues because they don't have enough cash to actually pay the taxes because it wasn't withheld at the time when they should have earlier on. We're going to go into a little bit more around what is employment income. And we're going to start with this definition of employee or independent contract. Now, I understand, Steve, this is very similar alignment and how an employee is seen as a independent contractor or an employee in this by the CRA or the IRS.
I think there are a lot of the same factors. I mean, you see on your third bullet point a 20-factor test in the US. Canada has had different types of similar types of things, maybe less factors when you think of some of the case law where this has been formed. There's a key word in that, and the word's control. Who is controlling everything in that relationship, whether it's when do I start work to what days do I work to whose equipment do I use to when am I paid to who's telling me what to do and who hires my assistants. And when you go through all these different tests, the more control that an employer has over how the work's done, when it's done, when how you might perform that, who's providing the tools, the more it's an employer-employee relationship. In contrast, if the idea is to say, well, I want to be if it's going to be a contract relationship, that means the individual is setting how they're delivering the services, when they show up for work, who they have working with them, how they're paid. They may have a little more, they may provide their own equipment. They may pay their own travel expenses, for example. That's more of a contractor type relationship.
Yeah, and I think as a Canadian employer, if you're going to have employees going down to the US, you have to follow the same US federal rules around what are the worker classifications. And the IRS also has the authority to come back and revise, see what is the actual intended relationship. But similar to Canada, the IRS has that same broad factors to determine the employee status. I think both the IRS and CRA, to your point, they're going to really look at that from the employer's perspective, say, do we actually have an employee relationship here? And for the rest of today's webinar, we're going to look at this from the prism of we're talking about a dependent employee. So we're not looking at this from a self-employment or from an independent contractor. A lot of the discussion today is assuming that the worker is an employee of the Canadian company. Now, with regards to the US-Canada treaty, look, we had an earlier webinar, actually one of the first ones for BizTax, that talks about, what is the threshold before a Canadian company needs to, what is the threshold that a Canadian company needs to meet under the US-Canada treaty? And that threshold is a permanent establishment wherein now the Canadian entity is going to be subject to US federal income taxes. So from the perspective of having cross-border workers, how can a cross-border worker performing services in the US trigger a permanent establishment? And with this, we look at the deemed services paragraph in the US-Canada treaty. And there's really two ways to get there with your cross-border workers. The first one is what we call the key person permanent establishment. And this often gets smaller Canadian businesses that can rely on a key individual who is essentially generating significant revenue of the business. And if that individual is going to be present in the US for a period of 183 days or more in any 12-month period, And, and during that period, because they're a key individual, they're generating more than 50% of the gross revenue for the entity, and those are from services from that individual, then the Canadian corporation can have a US permanent establishment. And so with that key person permanent establishment test, you really do need to count all the days that that key individual is in the US that could trigger a permanent establishment.
Well, I think it's a really important one that companies often miss, because they'll think to say, well, we don't have an office in the United States, we don't have a plant, we don't have a facility, we don't have any big long-term projects or big construction or installation projects. We're just sending people down there to kind of consult or deliver services. They don't even have business cards down there, so we don't have a permanent establishment. But as Namir points out, you know, a company or an individual can create one by its physical presence in the United States, delivering services, even if those services are delivered, from a hotel room in the United States or from the client's premises.
And that goes regardless whether it's a weekday or a holiday or a weekend, if they are doing that work in the US. The other one to think about with the deemed services PE, the second prong of it, is what we call the long-term project permanent establishment. And so this one generally requires that you have more than one Canadian employee, and they're across multiple locations across the US. And with this test, essentially the services are being provided in the US over a period of 183 days or more in any 12-month period for same or connected projects. And when we say that, could be, projects that are commercially or geographically cohesive. And it's for either US resident customers or for a US permanent establishment of a non-US entity. And again here, you only count days that they're actually on the project. And so what I mean by that is, if you have, as a Canadian company, several employees going down to the US and they're all working on that project, you're not going to double count and triple count each of their days to see if they're going to meet that threshold. You're only going to count as one day for each employee working on that project in the US. The risk you have with both of these tests, I think, is important to think about as a Canadian employer with workers going down to the US, is, if you notice, the language that I just used there earlier was any 12-month period. And, so it's essentially a rolling period to test if you have a permanent establishment in the US. So that also causes a bit of a rolling headache, because by the time the Canadian company can determine it has a US permanent establishment, and it could be subject to US federal taxes, it may have already filed its Canadian tax return on a calendar year end. So there is a risk there that the Canadian tax return might have to be amended, and potentially even the US tax return, based on that moving and rolling 12-month period. And just one more thing, I guess, before we move on from here. Now, we talk about permanent establishment. The reason permanent establishment does matter for a Canadian company from the context of its workers that are crossing the border is that if the Canadian corporation is then deemed to have this US permanent establishment as defined in the US-Canada Treaty, then it's going to also impact its US federal payroll obligations, as well as the Canadian employee's own personal federal income taxes. Now, there is an article in the treaty that provides some additional protection, assuming the salary is less than $10,000 in the currency of the states, that's the US, or if they're present in the US for 183 days or less. I want to talk about next business travelers. And by the way, business travelers is a very broad term. International business travelers often do fall below on the corporate radar. And this is really critical, is that when we're talking to our clients, we always advise them that we want Canadian employers to really track and monitor these employees that are crossing the US border, when they're going on a business trip, for example. And the question that's going to be really important here is, if you have an employee doing business travel in the US, who has the primary right to tax their employment income when they go to the US? Well, Canadian employees who are doing a business trip to the US are going to be considered to have performed their employment duties, their work, in the US. So that employment income is going to be sourced where the employee was physically located, where they were performing their employment work. And that employment is going to be sourced on a time basis. So both the CRA and the IRS, they both accept that the method of tracking the number of days for an employee is going to be based on their physical location in each, jurisdiction, US or Canada. So that's how you're going to source the income for those business travelers. So that being said, the US will be able to assert its primary right to tax the employee's US source income, but there is also a de minimis exception there from a US domestic tax law as well for $3,000 or 90 days. Now, the other thing to keep in mind here too is we're talking obviously for most of this from a federal income tax perspective. States, state and local jurisdictions, they also can impose personal taxes and may have their own state source employment income for the time that the employee is spending in the US.
Well, I think this gets into a really complicated area when it comes to you get business travelers. You mentioned this de minimis limit for federal law, and it's $3,000 of employment income. So for a highly compensated individual, an executive, that may be a week's worth of travel. So that doesn't help much. You can then go to the next stage for federal tax that says, okay, Canada and the US have an income tax treaty, and there's provisions under the Canada-US income tax treaty that if the individual is working in the United States and makes less than $10,000, and that's $10,000 in the currency of the country, so it's be 10,000 US, then they wouldn't be subject to tax federally in the United States. Okay, so we've gotten that high compensated individual. We've got him a couple weeks, he or she a couple weeks in the US. Okay, once you get past a couple weeks in the US, now you're taxable. There's another provision in the Canada-US tax treaty that goes through a series of tests that says if you're under 183 days and your compensation is not borne by a U.S. firm establishment, then you wouldn't be taxed. Then you wouldn't be taxable federally. And so, there can be some exemptions there. You make a great point, though. And we talked a bit about states, and you mentioned Palm Springs, California, when we were talking at the beginning. California is one of those very aggressive states that does not follow the Canada-US income tax treaty. And so all those things I just told you, California couldn't care less. If you're an employee and you're physically working in the state of California, you're subject to tax on some proportion of your income based on the number of days you're physically working in California. Other states may have similar rules. So you just need to be mindful of that.
That's right. And, there are several strategies that we try to provide help to clients to help them manage this risk, including advising them to review the expense or travel reports, looking at intercompany charges for those kind of compensation costs. If I was in the employer's position, I'd want to know even things, for example, are there any work permits or visa applications that are being made? But, you do want to monitor that travel. That invisible border can have quite significant tax implications. So you want to monitor that travel either ongoing or periodically, and whether it's a third party doing it for you or a designated employee, it will be important. And you want to get to a place where you can also develop a policy to help manage the risk for employees when they're crossing the border, so you can address the corporate and the personal tax implications, so it aligns with what is the company's overall tax strategy, what are its goals, what is its cross-border tax profile. For example, if the Canadian employer is filing a treaty-based return that was basically saying that we're not subject to US federal taxes, does this actually align with the business travel that its employees are doing? We want to go through an exhaustive list of all the things to look for, but like I said, I think it's really important to have those policies in place, so you're understanding that as you're tracking the work days and the destinations, you're making sure that the right withholding taxes and remittances are being made. I'll talk briefly here also about away from home expenses. I know we have a similar equivalent in Canada. These are essentially when you have deductible expenses while the employee is temporarily away from their tax home. These could be treated as not taxable compensation. You have to meet certain criteria, and it really depends on how much time you're spending in the US, whether you're at a single location or not. But there are some complications with this that we're not touching on, and that's looking at, for example, when you have commuters or a break in service, what we call stopping the clock, or if you send an employee on several short-term assignments. And I believe Canada has that similar equivalent with the special work site allocation costs, where similar thing where you're looking at the boarding costs, lodging, and transportation at a remote location.
Yeah, the details of that probably wouldn't fit into this webinar, and maybe it's a topic for one of our 2024 webinars.
Looking forward to it. All right, so I guess that brings us over to our first polling question. So the IRS may consider the following factors to determine if an individual is considered an employee or an independent contractor. A, working on the employer's premise. B, the worker's right to terminate the relationship. C, working more than one business at a time. And D, all of the above.
I think this question goes to the 20 factors we talked about here, all these different subjective factors on control. We hear a lot where an employer and an employee or a company and individual want to have a contract relationship, and they say, well, we'll just put it in writing. We'll have a contract relationship, but it's really clear that this is our intent because we put it in writing. And that's a factor. That's not something to ignore, but that by itself won't get that determination. You've got to look at all the substantive factors and assumptions and conduct behind to determine whether you truly have a contract relationship, or does it more like an employee relationship?
Looks like most of the audience got that right. It's all the above. Fantastic. All right, so we go to Steve. We're going to talk a little bit about the tax equalization process, and when is this relevant, and what is this about?
Sure, you see this often, and so to back up, the idea here is that if you're an employee and you're being asked to work in a different jurisdiction, it's complicated. You're being asked to now pay tax in a different jurisdiction. You had a relationship with in our case Canada, where you had your wages subject to withholding. You got a tax slip at the end of the year. You filed a tax return in Canada. You were done with it. Well, now it's a lot more complicated because you got the federal government in the U.S. potentially involved. You got states involved. And so the idea here between equalization or any kind of protection policies is the company goes to the employee and says, we need you to go work in this other country. We need you to go work for an extended period of time. We don't want you paying any more tax than you wouldn't already pay if you never left. And the idea here is you're trying to encourage the employee to say, we've got you. We'll take care of you. Go do this work. Focus on that. We got everything else behind the scenes. In general terms, when an employee goes from Canada to the United States, there's nothing really to equalize or protect, because oftentimes the income tax liability in the US, even with state taxes, is less than it was if you just stayed in Canada. And so with mechanisms of foreign tax credits, just filing tax returns properly, the employee is going to probably be whole and they're not going to pay any more tax. You see equalization policies more on the other direction when a US employee comes to Canada, and the US employee might have only been having a tax rate of 20 or 25% on average, and now they come to Canada and it's 40% on average or something, and now they're paying more tax. The company that says, hey, we'll protect you and make you whole. It's relevant either direction to make sure that the employer and the employee understand what the obligations are, what the employer is going to do for the employee, what the employee is going to agree to as part of the assignment. And we always recommend to come to this situation is companies should be ensuring the employee understands what's going on here. And it may sound a little self-serving when we say, hey, you should get tax advice, and Andersen will provide that tax advice to you. But the importance there is the employee has to understand that there's going to be tax returns. There may be, cash that's not withheld and sent to Canada. It may be directed to the United States, and how do you reconcile all this? And it's important to get independent advice to the employee to say, hey, this is going to be different. This is what we're going to do. Here's who's going to help you. And by doing that and having it in writing and having an agreement before the assignment starts, it goes a long way to making sure the assignment runs smoothly and efficiently and effectively.
Awesome. Thanks, Steve. So we're going to go into now, what are some of the considerations? We're going to start with looking at, what does the Canadian employer need to think about? What are the tax considerations for having the cross-border workers? And, from the Canadian employer's perspective, the first question is, when you're dealing with a worker, are they a US person or are they a non-resident alien? And so assuming the worker is how the US defines as a non-resident alien, and we're assuming they have US source income because they're performing services in the US, and also assuming it's above the de minimis threshold, then the income taxes are going to be withheld at graduated rates. Again, assuming they're also not exempt from the US federal income tax under the treaty. So the employee for the Canadian employer will need to make sure they fill out a W-4, which will basically show what the employee's withholding allowance certificate is, or a Form 8233 if there's no withholding required. Now, on the other hand, if the Canadian employer has a U.S. person, what happens there? And by U.S. person, that means either we're saying U.S. citizen or a U.S. resident. So let's talk about that briefly. If you were a U.S. citizen, generally a Canadian employer generally wouldn't withhold when they're performing those services in Canada, because they're generally going to be relying on them having, being eligible for the foreign earned income exclusion, or the income is subject to foreign income tax withholding. But there is some complexities here, right? Because when you're the interplay of the withholding exceptions, when you have a Canadian employer sending a U.S. citizen to do work in the U.S. on behalf of a Canadian employer to perform those U.S.-based services. It's also really important here that if you are dealing with a U.S. person as a Canadian employer, you do collect the W-9 from those U.S. persons for any of that U.S.-based activity that's done. Now, with regards to federal payroll compliance obligations, the Canadian employer will need to file a Form 941, and that's basically to report income tax withholdings. And the payments could be remitted monthly, it could be semi-weekly, or even daily, depending on the dollar amount. But the Canadian employer, this is the important piece here I want to communicate when you're driving this strategy, is, the Canadian employer is going to be required to make electronic funds transfer. So they need to set up with the IRS in their EFTPS system, it's their electronic fund system. And that takes time. So you want to make sure you get this done and you get it done right, so you're not missing out on the payment deadlines after the employee has started going to the US, and then you're going to be subject to penalties on that. So a theme you're going to be hearing often throughout any one of these bullet items here is that, there's multiple civil penalties for non-compliance. With that Form 941 that reports the income tax withholding, there is a failure to file, there's a failure to timely pay, and that can go up to as much as 25% penalty for the taxes owed. Mind you, there are penalty abatement options available, but when both those penalties can be imposed, kind of in a worst case scenario for the maximum period, it can go up to almost a 47.5% penalty. So something to look out for. And there's other penalties that we're not going through, like, for example, the accuracy related penalty to making sure you're getting it right, failure to deposit the taxes, and so forth. The Canadian employer also needs to prepare the W-2 annually for each employee. So this is reporting the U.S. federal wages paid and the taxes withheld. And this is provided to both, the employee and the U.S.'s Social Security Administration. Also with that, if the W-2 is not filed on time, there's a penalty, and there's also failure if you're not providing it to the employees, which can also carry penalties. Now, some of the other employer obligations you need to think about when you have workers in the U.S. is, the first I'm going to talk about here is FICA, which is the Federal Insurance Contributions Act. And this essentially applies to wages for services performed by that employee in the U.S., regardless of what is their citizenship or their residency of either the employee or the employer. And this is a cost for the employer and the employee, but the Canadian employer has to remit both payments. And this is essentially similar to in Canada here, the CPP plan or the old age security plan. But essentially here, you're supporting US Social Security and Medicare programs. And of course, failure to withhold on this also has penalty for failure to comply. The next one here is the federal unemployment tax. This is an employer-only tax, and this is also to fund the U.S. federal unemployment program and applies to wages for services performed in the U.S., again, regardless of citizenship or residency of the employee or the employer. And the Canadian employer will be required to pay this, assuming they meet certain thresholds. And there are exceptions in the US-Canada agreement to prevent double coverage. And a recurring theme, of course, failure to timely file this will result in, or to pay the deposit can also result in penalties. And there's also accuracy penalties here too. There's also here the Obamacare requirement here. This is Patient Protection and Affordable Care Act. This ensures all Americans have access to affordable health care. Essentially, it results in employers subsidizing healthcare insurance. And of course, there's penalties for failure to comply to this. And the other consideration is state and local, which can include cities, income tax withholding. And so this applies when an employee provides services in a state or a jurisdiction that can tax employment income. And again, failure to withhold here has interest and penalties. And the other thing to keep in mind here, just with states, is some states have their own unemployment tax collection systems that require employer remittances. So it's really important, when you are sending employees to the US, you want to make sure you're also reviewing these state and local tax issues.
So
now,
before we leave, is your goal here to do the next polling question, Namir?
Yes.
Yeah, and this is going to be a really good question, I know. I can never leave this topic or slide without pointing out one thing, and it's an opportunity, and it's something we've seen for decades, and it's often missed, but it's a real win when companies and employees fit this. And it's that very second bullet point, the Federal Insurance Contributions Acts, or FICA. So in the US, you have Social Security taxes, you have Medicare taxes. The program is a large one. The payments when you retire are higher than you get in Canada. The taxes are much higher for companies and for individuals than they are in Canada. For example, someone making $150,000 a year as an employee, if they stay in Canada and they work in Canada, their Canada pension plan between the employee's contribution and the employer's contribution is about $8,000 Canadian next year. It's somewhere between $7,500 and $8,000 total, half paid by the employer, half paid by the employee. You take that same person, and if they are working in the United States making $150,000, that combined total is close to $22,000 per year, half paid by the employee, half paid by the employer. So it's almost 3 times higher. Now, you may think it's a great win to be paying into this real robust program, but these are government pension plans that have a low rate of return. And if one could look at this as taxes and save the taxes and take the difference and invest it, they would be much better off down the road. So for the individual and the company to save this tax, Canada and the United States have something called a Social Security Agreement. It's been around for decades. And the idea is if an employee is transferred from one country to the other on a temporary basis to an affiliated employee, and those are the requirements, for up to 5 years, they can be covered under their home country's plan and avoid and eliminate their new country's Social Security taxes. So wrap that all up, a Canadian employee being transferred temporarily to an affiliated US subsidiary, parent, sister company, you tell me what it is, let's say it's affiliated, if they can be covered under Canada Pension Plan, on a combined basis over 5 years, if you said, I'd rather pay $7,000 to Canada versus $22,000 total to the US, we save $15,000 times 5 years, $75,000 we're saving, half by the employer, half by the employee. It's really worth looking into seeing if you can be covered by this. We work with this often, and I can't let this slide go without talking about that.
Yeah, Steve, you also bring a good point here too, when you're looking at it from the Canadian tax lens as well, because in Canada, you're going to be taxed as a Canadian resident on your worldwide income. So they're actually technically still a requirement to withhold income tax on their worldwide wages. But there's also an opportunity there to in terms of procedures that we could do to reduce the withholding that they're going to have from a Canadian perspective when they're traveling to the US and getting withheld on their US income as well. And that brings us to our next polling question. All right, sorry, it's a bit of a long one here, but let's go through it. Fernico is a Canadian employer with a Pennsylvania-based employee from 2021 to 2022, but the company did not fulfill its 2021-2022 U.S. federal withholding and reporting obligations. Which of the following is correct? A, Fernico may be subject to multiple civil penalties. B, Fernico can pass all U.S. federal withholding and reporting obligations to the employee. C, Fernico is never subject to U.S. civil penalties, or D, all the above.
I don't know what Fernico is, but I know Namir is an avid downhill skier, and I know there's some fantastic skiing in Fernie, British Columbia, and I'm taking a wild guess that's where it's coming from.
That's exactly where it's coming from. When in Calgary, that's the best excursion for skiing near.
Excellent.
Hey, Steve, I promise I do one tax joke at some point. So
I think this is time for it.
Why are accounting departments the most welcoming?
I don't know.
Because they know everyone counts. Sorry. All right, looks like most people got that answer correct. A, Fernico may be subject to multiple civil penalties. Fantastic. All right, back to you, Steve. We're just going to talk a bit about the considerations for employees from a personal tax perspective in terms of what do the employees need to think about for both the U.S. and Canadian income tax consequences. And this includes, changes in residency, foreign tax credits, and Canadian pension plan contributions.
Well, and I think that's a wide-ranging subject. I'll try and narrow on a couple of these things, knowing we've got a little bit of time left here. Part of what I talked about before is employees should be getting advice. This is a different experience to go work for a significant amount of time in the United States. One of the first things you're always thinking about is residency, and we've had lots of webinars in the past, and we've talked about residency and its importance. Residency is the concept of which country gets to tax you on the worldwide income and your worldwide assets. Short-term assignments where you're leaving Canada and working in the U.S. for a little while, generally you're going to remain a Canadian resident for income tax purposes. And so while you may be subject to U.S. federal and/or state income tax, Canada is going to give what's called a foreign tax credit, meaning you're not going to pay tax twice in the income. Canada's still going to tax the worldwide income, including all the income you made in the United States. But Canada's going to say, okay, we recognize that you physically work in the United States. If under the Canada-U.S. income tax treaty, you are subject to U.S. federal and state tax because you don't meet any of those exceptions, then if you pay U.S. federal or state tax, we'll give you a dollar for dollar tax credit. And so in general terms, when Canadians go to the United States, and if they're not residents in the United States, they're what's called non-resident aliens. In the U.S., they're only generally paying U.S. federal and state tax on their U.S. source income. In this case, it's wage income. Those rates will be lower than Canadian rates, and so you'll get a full foreign tax credit. You shouldn't be any better or worse off by working in the United States. You're going to have some work to do. It's more complex. You may have some professional fees. You should be working with your employer to coordinate that effort. You are probably, if you're a resident of Canada, you'd still be eligible to contribute to your pension plans. I tell people this though, that it's necessary to model these things out because foreign tax credits are different. You may have never seen them before. When you spend a significant time in the United States and you just blindly go and say, I'll make a pension plan contribution as well, you may find that it's not a perfect match. You want to claim those foreign tax credits first, because if you don't claim them in a year, they disappear. You may or may not want to claim your pension as well. It's a mathematical exercise. You model it out, you do mock returns to kind of get a conclusion to say, okay, how much, if any, should I contribute to a pension plan in Canada? You may be surprised at the results. You may see an individual who's got a lot of Canadian deductions. They got medical expenses, charitable contributions, things that are deductible in Canada, not in the U.S. And all of a sudden, making a big pension contribution doesn't make much difference. So,
fantastic. Thanks, Steve. And that gets us to our last polling question. Canadian resident employees performing U.S. related business services from his employer's Calgary home offices. Assuming there's no state income tax consequences, where is the employee's compensation income source? A, the U.S., because the employee is performing services for the U.S. business for U.S. customers. B, Canada, because the employee is physically located in Canada while performing services for the U.S. business. C, Mexico, the employee is technically dreaming about Mexico while working in Calgary. Or D, none of the above.
It's a good question in the sense that I think a lot of people often look at currency they're paid in or which entity they're being paid from and saying, well, that's where I'm taxed. And that's not generally the answer.
Or they're looking at the
Uh,
customers and saying, well, I'm serving my
sure.
US customers, so clearly this has to be US source income because the revenue is coming from a US customer. And so they're
Yeah,
transferring out cash to the Canadian employer.
absolutely.
Correct. Most people got that answer correct. It's B, Canada, where the employee is physically located. All right, that brings us to our final slide here, and that's around strategies and tax planning ideas. Now, we talked earlier when we were looking at the idea of workers crossing the border and there's more and more business travel, we'd want to make sure that when we're working with our clients that we talk about some of the internal controls around monitoring that business travel and tracking that time. Because, you really want to know as an employer, what are your tax reporting obligations? Are there any payments? And critically, a question you need to think about is, are there any changes to your not only strategy, but actual tax positions? For example, a permanent establishment from this cross-border travel that's happening. And, the other thing we talk about with our clients is you do want to develop what we call a withholding tax strategy. So for example, when you know that you have employees going down to the US and they're being paid while during their time doing their work in the US, what are your how are you going to pay for their US payroll and withholdings? And there's going to be questions there around, do you want to use your existing payroll system from, let's say, if the company has a US branch or if you have a US subsidiary, or do you want to have the US entity, if you have a subsidiary, act as the Canadian company's payroll agent? Or do you want to use, for example, a third-party payroll service company? So there's a lot of questions that come into play that you have to plan for. And the other question will be, well, how do you, for example, want to fund this withholding tax if you're going to be subject to taxes in both countries? How do you manage the cash flow? So there's a lot of considerations that need to come into play as those employees are crossing the border. And by the way, there's opportunities that you can have with, for example, filing an application with the CRA to reduce those Canadian withholding taxes if, for example, you're anticipating foreign tax credits from the US tax liability. But the key thing, and the reason we say you really want to develop this strategy is, that application, if you're looking to reduce your Canadian withholding taxes, this can also take weeks to do. So before it gets approved and before you're actually able to reduce your withholding. So you want to make sure you're planning for this ahead of time. There's also circumstances where Canadian employers may want to advance funds to their employees to help pay for that US tax liability. And then the employee could return that back when they get a refund once they get their foreign tax credit claimed on their Canadian tax return. Now, the key thing here, again, is you really want to make sure as an employer that you've set up the processes and procedures, maybe have an agreement in advance with the employee so they're very clear that they have to repay this back. Otherwise, that could be a really expensive compensation item for that employee, for the employer. Another thing I'll add here is with regards to the transfer pricing strategy. So you really, we talked about this last month. You'll want to make sure that those compensation costs are being allocated according to where the services are actually being performed, and making sure that the company's tax returns and the business travelers, the employees' personal tax filings, all of that aligns and jives with the transfer pricing strategy. You want to ensure that there's consistency all the way through. And the last thing I'm going to address here is with regards to secondments, and this is especially true when you have a Canadian company with a US subsidiary. So often the Canadian employer will decide they want to, for example, loan or second an employee. And this is, typically more of a long-term arrangement. And so essentially what happens here is that worker is working for the benefit of the US subsidiary. And it's really important. Sometimes we see with clients, this is done in a very informal way. We would recommend getting that secondment agreement to make sure that the Canadian employer is managing its tax risks and ensuring, for example, that they're not going to be subject to a US permanent establishment from that secondment. And you can have that letter outline, what are the employee's terms and conditions, Do they have to, for example, provide any sort of refunds of taxes from a foreign tax credit, and making sure the employee also knows what their compliance obligations are going to be, as well as the employer from their long-term secondment to the US. So that wraps up our webinar for today. In terms of upcoming webinars, we have a couple more coming in the next few weeks. So we've got the Americans moving to Canada, also with Steve and Flynn and Krista Rabideau, and that's going to be on December 19th, 2023, and that's Tax 101. And BizTax will have the final series in the series around inbound tax, so from Canada to the US from a business perspective, and that's around sale and final exit of business. And as mentioned early in the webinar, we do provide a survey. So if you have any other topics that are top of mind, any suggestions, we would be more than happy to bring those in the next few months or the next few weeks, depending on the topic.
That sounds great, Namir. If you want to go back to that one slide there, the QR code on the right-hand side, that's the link to that December 19th webinar. That's our last webinar for 2023. And Chris and I look forward to talking a bit about some of the unique issues and strategies and opportunities for U.S. citizens moving to Canada, or green card holders, or any American for that matter. So.
Thanks, Steve. All right. So like as mentioned earlier, we will have a survey at the end of the webinar. Please let us know if you have any feedback, any topics you would like us to cover, and any suggestions on how we can improve on our webinars, both the BizTax and Tax 101s. So we're going to stay for the next, I guess we've got like 9 minutes for any questions from today's webinar.
Thank you, Namir, for the presentation. Our first question is about permanent establishment. Is the 183 days requirement met if 3 individuals are on a project in the US for the same 70 days during a 12-month period? Or the number of people present in the US on one day does not matter for that purpose?
Great question. Thanks, Lena. So I think the question being asked here is, when you have 3 employees from Canada going down to the US, does that somehow go over the 183-day threshold because the 3 of them are working on the project? Now, assuming they're all working on the same project, you don't have to duplicate the days so that it goes over 183 days if they are all working on the same connected project. So it is one unique day that they're all working on that project. It's treated as 1 and not as 3. So essentially, if they're there for 70 days on the same days, they should not be going over the 183-day threshold to have a permanent establishment in the US.
Thank you, Namir. The second question we have is about compensation for the loss of Canadian benefits due to higher employment income. Is there a way to compensate for that loss?
I'll try and answer this one. I believe the question talked about if you don't have the benefits. I guess I'm going to say because you've transferred from one jurisdiction to the other. It's a tough one to answer without no more details. I'd say this, that in general terms, compensation is taxable, and some of those benefits may be tax-free if they're health or other benefits. I think we'd want to know more about what type of benefits we're trying to cover. There may be ways to get, for example, if you're a Canadian employee being transferred to the US and there's high insurance or healthcare costs, there may be ways to exempt that from both US and Canadian tax, depending how it's established. And there may be ways to do that for other benefits as well.
Thank you, Steve. And then the last question we have is, what happens if the person traveling to the US for business is an owner of the company? Are there any different rules?
I think you really want to look at, there's several different ways to answer that. I mean, the first thing is when we were talking about the deemed services permanent establishment, so ways where the Canadian company can have a US permanent establishment. If that individual is a key individual who could be deriving a significant amount of revenue for the Canadian employer, that individual's time in the US, when you're tracking it, could meet that first prong of the deemed services permanent establishment. So there is an impact there. And that's from the services permanent establishment perspective. Now, that key individual can also, depending on what they're doing in the US, there's other provisions, other articles in the US-Canada treaty where they could also bind the Canadian company into contracts. For example, if they're signing or authorizing contracts in the US, then I would also be careful there where there's another avenue for them to trigger a US permanent establishment by nature of the activity that they're doing in the US.
Thank you, Namir and Steve. I think those were all the questions.
Hey, well, that's great. Well, hey, Namir, thank you for having me as a fill-in guest here, and I always enjoy these. And again, we hope Krista's feeling better, and we'll get back soon. And I'm sure she will be ready to go for our December 19th webinars.
Stephen, thank you so much for jumping in, and Krista, hope you feel better. And thank you everyone for carving your time for us today. Hope to talk to you soon. Take care.